Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Business as usual. The Fed keeps rates unchanged, citing inflation risks, but two governors vote against the decision in favor of making a cut, marking the first double dissent in more than 3 decades. More deals. President Trump hit South Korea with 15% tariffs. India, meanwhile, will face a 25% rate, possibly going higher over its Russian energy purchases. And Canada has become the latest G7 nation, planning on recognizing a Palestinian state in September, a move that's been quickly rejected by Israel. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Versace in Dubai. I almost don't know where to start. There is so much information that has come through in the last 24 hours, the big event being the Fed. But again, the Fed chair is sticking to wait-and-see mode, not committing at all to a September rate cut. And what we saw is markets price out the possibility of that happening in September. Going into the meeting, we had about 45 basis points worth of rate cuts priced in from now to the end of the year. We're sitting at around 30 basis points now. So that tells you the interpretation from the market was that it was a hawkish Fed. You also had very strong earnings come through from Meta, Microsoft, strong after-hours performance there, almost double-digit for both of them. So you can see the Nasdaq up 1.3% futures this morning, S&P up 0.9% as well, getting a bit of a boost from these earnings that are coming through. 2-year yields down 3.92%. So again, we sold off a little bit. Yields moved higher after that Fed announcement this morning. We're down again about 2 basis points. But the point is that the interpretation was that this was a more hawkish than expected Fed meeting. And the USD slipping a bit, down 0.1%, as we also speak to some of the new trade deals that the U.S. have announced overnight with the likes of India and South Korea, and pledges to do more before that August 1st deadline. We are 1 day away. So with that, let's talk about how some of these Asian markets are reacting to the deals overnight. And of course, the Bank of Japan, too. So much going on in your space, Avril.
Absolutely, Jumana. For the BOJ, we were expecting it to leave things on hold and really watching for what the tweaks to growth inflation outlook was. And for CPI, actually, the tweak was relatively mild. So that's helping dollar-yen to pull further away from the 150 danger zone, as our MLife strategists have characterized that. But aside from that, Asia stocks are lower. You have Hang Seng, really the drag today. We had weak PMI numbers and unexpected worsening on the manufacturing front, so showing you that softness in activity there, and at a time when exports for China not looking that great, and uncertainty still. Are we going to see this US-China trade détente extended in South Korea as well? Even though 15% tariffs is seen as a good outcome, today the drag is coming from Samsung after an earnings miss, and then just very quickly highlighting what we're seeing out of India stocks, that drag you're seeing against the backdrop of these levies, 25% that could be imposed and more to come potentially. And this is among the highest levels we're seeing, if not the highest in Asia, Jumana.
Yep. Thank you so much, Avril. And let's not forget, it's earnings season still, so a bunch of earnings hitting. Just getting results through from Standard Chartered. It is a beat. Second quarter adjusted pre-tax profit, $2.4 billion versus estimates of $1.9 billion. They've also announced a $1.3 billion buyback. They see 25 growth around the bottom of the 5 to 7% range. Operating income to increase 5 to 7% in 23 to 26. The return on tangible equity approaching 13% in 2026. They still talk about heightened uncertainty around trade tariffs, and of course, Standard Chartered, one of the banks that perhaps are a little bit more exposed to tariffs given the global nature of the bank and its exposure to emerging markets. And then other guidance, they are saying they expect saves of around $1.5 billion, cost to achieve of no over $1.5 billion from Fit for Growth, plan to return to at least $8 billion to shareholders between the 3 years of 2024 to 2026. But bottom line is, second quarter adjusted pre-tax profit is a beat, $2.4 billion versus estimates of $1.9 billion. And later on, our colleagues on Daybreak Europe will be speaking to the CEO, Bill Winters. So stay tuned for that interview. Now, President Trump says he's reached a trade deal with South Korea, imposing a 15% tariff on its exports. Seoul has also agreed to invest $350 billion in the U.S. and buy $100 billion in energy products.
Korea, as you know well, has always been very challenging on trade for the United States. We've had an agreement with them in past years, but our trade deficit with Korea has continued to be extensive. However, President Trump has raised the natural leverage of the U.S. market to really obtain some significant concessions from the Koreans.
Okay, more deals as we get closer to August the 1st. Let's take a closer look at this one and more with our senior editor, Bill Ferries. Bill, there seems to be a bit of a template that has been set up in the last few days. It's not just about the reduction of the tariff rate, but you're also getting countries committing to invest in the United States and also committing to buy energy products from the U.S. What does this all mean for a country like South Korea, especially given the negative market reaction that we're seeing on the Kospi today?
Yeah, I mean, for South Korea, I think it is. It's definitely better than. It's not the worst case scenario. It's probably better or at about what they expected. It is similar to the deal Japan got, 15%, a $350 billion fund that will invest in the U.S. South Korea did manage to protect a couple key areas, including beef and rice imports from the United States. That was something that was politically very sensitive for the South Korean government and the new President Lee, who just took office in June. So it is, frankly, one of the better deals. We're in a strange new world where 15% tariffs are up from about less than 2% at the start of the Trump administration, but 15% still seems like a relatively good deal compared to what some other countries have gotten, such as India.
Yeah, let's talk about India. And actually, Trump seems to be making a few comments about the deal now, saying we have done very little business with India. India tariffs are too high. And says, I don't care what India does with Russia, of course, referencing the fact that India continues to buy Russian oil. What do we make of the fact that India got a 25% tariff rate and South Korea got 15%?
Yeah, it's an interesting turn of events because we know President Trump and President Modi have had a good personal relationship going back to the first term when each of them hosted the other. President Trump has again hosted President Modi, Prime Minister Modi back at the White House this year. The two leaders seem to get along, but we have seen increasing frustration from President Trump about India's policies. Among the things he's taken issue with is the fact that India is a member of the BRICS bloc, the fact that you mentioned that India buys a lot of weaponry and oil from Russia. Those have been two issues. And India has had a long-standing policy of tariffs to protect domestic industry. That has come up repeatedly in the talks between the two countries. So I do think we see kind of the range of possibilities here between South Korea coming in at 15%. And India at 25%. If there is a silver lining for India here, it does seem that the initial reaction from both sides is that perhaps some talks will continue. So even though August 1st is the notional deadline here, there does seem to be some signaling that perhaps a better deal will be in line down the road.
Yeah, and perhaps later today as well, with other deals expected to be announced, including potentially one with Thailand, too. So we'll keep a close eye for that. Bloomberg's Bill Ferries, thank you. Now, Fed Chair Jerome Powell has warned that the central bank needs to stay on guard against inflation risks as the FOMC kept rates on hold. The 9-2 vote saw two governors support a rate cut, the first time since 1993. A Fed decision has had two dissenters.
I think you have to think of this as still quite early days. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer. But, you know, the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time.
Joining us now is Dan Farley, Investment Solutions CIO at State Street Investment Management. So the Fed Chair, Jerome Powell, not succumbing to any pressure. Certainly there's a lot of political pressure, wait-and-see mode. And if anything, I would say being very cautious about laying the groundwork or the foundation for a September rate cut. How do you interpret yesterday's press conference?
Well, I thought his comments that you point out here, it was actually quite interesting. I was very keen to see how he was going to start to message September, or whether he was going to start to say enough progress has been made or enough clarity was coming on tariffs, and he didn't go down that path. So I think that the The outcome of the day isn't very much a surprise. There really hasn't been enough data, I think, to have given them the comfort to move forward with a rate cut. So that pretty much in line with everybody expecting. But it does leave the door open in terms of what might happen in September.
Yeah, I guess I'm surprised to see that the dots are still projecting 2 rate cuts by the end of the year. But yesterday he refers to the labor market still looking solid. You still have inflation slightly above target. So what is the justification to cut rates at this point?
Well, at this moment, there isn't much, and that's why they didn't do it. And I think that's why they continue to go back to this point around the data is so important that they need to start to see that flowing through. And that's why I think the end outcome isn't that much of a surprise. They don't have the air cover to have made that decision. I think people are all looking forward to what could be as the desire to say that he would commit to something. But they've been very clear all the way through that they weren't going to take that kind of.
What's the House view on what the Fed do next?
Yeah. So we think that they're likely to do 50. We think they actually probably should do 75 this year. And we say that because the trend that we've all been seeing has been a slowing economic growth rates. It has been inflation that has been trending down. Admittedly, in the first quarter, we saw a bit of a tick up. The tariffs are adding to all of that. But the trend is going in the wrong direction. And we think that they are falling behind on this point. Now, the reality is, until they get that data to support it, they're really not going to be able to move. You saw it in his comments yesterday. They're still very, very cautious about moving too quickly and having inflation turn the other way.
Yeah. Let me ask you about all of the trade deals that are being announced. And I feel like the price action after those deals are announced is pretty interesting because the country that agrees to the terms of the deal tends to underperform in the days afterwards. So I think there's a perception that these trade deals are actually ultimately benefiting the U.S. and not necessarily benefiting the other countries in the deal. Do you think we've moved to a stage now where investors, at least those focused on the U.S. market, are less concerned about what's in these trade deals? We've moved on from trading all of the tariff headlines?
I don't know if we've quite moved on from it, but I think we're definitely sort of identifying the playbook, as you noted a few minutes ago, that it's a rate that's in around 15 to 20%. It has a little bit of investment. It has an energy buy. It might be a couple of other things. So I think that pattern is definitely showing itself up. I think that the fact that we're coming in at levels that were a bit lower than people were expecting, clearly off the highs of April, but coming in lower than where people were expecting gives a little bit of comfort. I'd also say, to your point, that the markets do sell off a little bit, but then a few days later, that just sort of washes away. Right?
Yeah.
So I think it's definitely been a situation where, buy the rumor, sell the news kind of moments.
Well, this was always going to be a big week for U.S. markets, and we've got stellar earnings out of Meta and Microsoft overnight. To what extent do you think that's going to be setting the tone for where U.S. markets go from here?
I think that's one of the most critical things that we can look at here, particularly in U.S. markets. And while we're slightly positive on equities in general, we are much more positive on U.S. stock markets. The economic backdrop there is stronger than other parts of the world. The earnings piece of it, most importantly, is strong. I can't say that U.S. stocks are cheap, but we need the E in the PE ratios to come through in order to justify those valuations. And thus far we've been seeing that.
Yeah. Do you think U.S. exceptionalism is back then? Remember that whole theme got tested a couple of months ago?
Well, look, I think that the concept is waning. All right. I think that the fact that the U.S. has been able to continue to deliver growth, in our mind, will have legs to that and will be a tailwind for U.S. stocks. But it does seem that the world is leveling out, and I think you're starting to see improvements in Europe from a fiscal spending and from a growth rate perspective. You're starting to see some improvements in pockets of Asia. So I do think that the investment story widens out a little bit, that it isn't just about U.S. stocks, but in the near term, that's probably still going to be the case.
Okay, so in this environment altogether, what would you rather own, fixed income or equities?
I'd rather own equities.
Still?
Because
of that AI story?
Well, I think AI is part of it. In fact, that's probably the piece that could potentially be that catalyst for productivity, much like we saw in the 90s that the internet was, right? We'll see how that ultimately plays out. It will take a little bit of time, but I think earnings will still grow. Economies are growing fast enough that it'll move stocks better than bonds.
Yeah. Great to chat to you, Dan. Thanks so much for coming on our
show.
Good
to see you.
Dan Farley, CIO of Investment Solutions at State Street Investment Management. Oh, coming up, as we just spoke about, Meta and Microsoft shares rise in late trading, with both companies focusing on AI investments. Details next. This is Bloomberg. right, taking a look at NASDAQ futures now after Meta, Microsoft, and Qualcomm posted results. Meta shares jumped in late trade after a strong third-quarter sales forecast as it continues to invest heavily in AI. Bloomberg Technology's Ed Ludlow has more from San Francisco.
Meta had a really strong quarter, and its projections for the current period also were very strong. But the bit that surprised was the commentary that capital expenditures in next year, 2026, will grow at a rate that is above this year. They'd narrowed the capex range to be between $66 billion and $72 billion as they continue to invest in infrastructure, data centers, but also top AI talent. And while the bread and butter business, advertising principally, is doing really well, they're basically saying that this will keep going and that they will continue to raise the investments that are needed to do the data center build out, to hire that top talent in the AI domain. There were some interesting disclosures in there. For example, in the quarter gone, AI smart glasses, the Ray-Ban Metas, outperformed and grew in the quarter while sales of Quest dropped. And I bring that up because earlier in the day, Zuckerberg had tried to explain what superintelligence really looks like, how people will interact with Meta in the future. But a lot of the emphasis on the call from the executives was about how the investments in AI were actually paying off internally first, helping product teams do better. And then you have Microsoft, really similar story on record spending, but we got some data points that are really interesting around Azure. So overall, Azure cloud growth 39% in the quarter, above estimates of 34.2%. But for the first time, Microsoft is telling us in dollar terms how much revenue they're getting from Azure, stripping out all the legacy products. So in fiscal 25, the quarter that just ended was the fourth quarter of fiscal 25, they booked $75 billion of revenue from Azure. That compares to $112 billion from Amazon AWS. So they're like still a distant second. But clearly, this is something more tangible. Investors can see the capital expenditures, which are similar on a full year basis to Meta's, but also the top line growth that's resulting directly from AI. Some other interesting data points as well. 100 million monthly users of Copilot, indicating that across enterprise, but also knowledge workers, individuals, their own AI offerings are starting to gain traction with a broader base. This is Ed Ludlow for Bloomberg News in San Francisco.
So very strong earnings from Meta and Microsoft. The Samsung's chip division reported quarterly profit that actually fell far short of expectations, reflecting a deepening crisis at the world's largest memory chip maker. The unit reported operating profit of $288 million versus analysts' average production of $2 billion. The company says it was hurt by U.S. export controls on high-bandwidth memory chips and losses at its foundry arm. And coming up, Canada joins France and the UK, saying it's planning on recognizing a Palestinian state. All the details next. This is Bloomberg. Canada has become the latest G7 nation to plan on recognizing a Palestinian state at the United Nations summit in September. Prime Minister Mark Carney says that the declaration is tied to political reforms to be made by the Palestinian Authority. Israel was quick to reject the move, with its ambassador to Canada saying it would not bow to a distorted campaign of international pressure. Joining us now is Bloomberg's Dan Williams. Dan, there seems to be a lot of momentum in the last couple of days with some of these major countries around the world moving towards a recognition of the Palestinian state. What is behind that momentum, and how much pressure will it actually enact on Israel?
Well, this conference was planned well in advance by a number of countries, really exasperated, worried by the conduct and the direction of the Gaza war. This war is now almost 22 months old, and I think even Israelis would confess at this point that whence the war is going is a matter of an open question. It appears to have abated to a degree while the Netanyahu government weighs whether to conquer the entire Gaza Strip or perhaps change its own demands for a ceasefire with Hamas standing firm. It would appear that a number of Western countries are stepping into that breach by offering what they hope would be their own solution. Now, Israel has written this off with the support of the United States. It says that a premature recognition of a Palestinian state would affect effectively reward Hamas for launching this war with the October 7th attack. It's worth noting that none of the plans presented by these Western countries as part of their vision of Palestinian statehood really gives details about how they would do away with Hamas in the Gaza Strip. Hamas also has support in the West Bank. The Israelis, however, do not have a plan of their own for what the day after a Gaza war, even if that war would be won by Israel, would look like. So there really is an impasse here, and I think the Western countries involved in this would say they have to save the two-state solution. This is something that's been talked about for decades. It's been moribund for around a decade, and now it really appears to be at death's door with widespread destruction in the Gaza Strip and really a polarization of both societies.
And there are reports overnight that the special envoy to the region, Steve Witkoff, is heading to Israel, presumably to analyze the humanitarian situation on the ground. What do we know about this potential upcoming visit?
Indeed, his office has confirmed he's coming here. There's very little detail. Witkoff is not just involved in humanitarian arrangements for Gaza, he's also involved in ceasefire talks. Those ceasefire talks that Israel withdrew from, at least provisionally last week, given what Israel and the United States described as intransigence by Hamas, Hamas hardening its positions, its demands for a ceasefire. It's very possible that Witkoff is coming for a consultation with the Israelis, perhaps a last-minute consultation, before they launch what they have hinted could be a final push into areas of Gaza as yet unconquered in an effort to destroy Hamas and retrieve hostages, even if such military action puts the living hostages at risk of death or injury. There is an impatience here within Israel with the situation, also an impatience in the United States, and again, a sense that Hamas has simply been emboldened by the recent diplomacy abroad.
Bloomberg's Dan Williams, thank you so much. Now, earnings season continues. We're getting some more breaking news, this time out of Société Générale. The number is here. So fixed sales and trading revenue has come in at 650 million versus 573 million. They have lifted their return on tangible equity target, also unveiled a 1 billion euro buyback. Cost-to-income ratio for the year below 65%, saw below 60%. So marginal boost to the guidance on both the cost-to-income and the return on tangible equity targets, and a 1 billion euro buyback, a beat. All right, we'll be back in just a few moments for more on earnings and the Bank of Japan. This is Bloomberg. Good morning. This is Horizons Middle East and Africa, our top stories this morning. Business as usual. The Fed keeps rates unchanged, citing inflation risks, but two governors vote against the decision in favor of making a cut, marking the first double dissent in more than 3 decades. More deals. President Trump hit South Korea with 15% tariffs. India, meanwhile, will face a 25% rate, possibly going higher over its Russian energy purchases. And a tech boost. U.S. futures rise on upbeat Meta and Microsoft results, bolstering optimism that corporate profits remain resilient. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Versace in Dubai. Well, we had the central bank meeting. We had earnings. We've got more earnings hitting today. Other central bank meetings. Bank of Japan, so busy the last 24 hours. This is the picture for where U.S. equities are trading. S&P leaning towards another positive open, up 0.9%. NASDAQ up 1.3%. No doubt boosted by Microsoft and Meta earnings. And the fact that the Fed chair continues to be in wait-and-see mode, not really committing to that September rate cut. So two-year yields we have moving slightly lower this morning, down 2 basis points. But the big theme of the last 12 hours or so was investors pricing out further expectations of rate cuts for this year. We've got about 35 basis points worth of rate cuts between now and the end of the year. The USD is slipping a little bit, down about 7 basis points. But let's flip over and also take a look at some of these key Asian markets as well, because we did get more trade deals overnight. We got a deal with South Korea. And as you can see, the Kospi index actually is down 0.5%. 15% baseline tariff rate there. But we'll talk more about that in a moment and what this means for some of these Asian economies. Negative reaction. Hang Seng, the handover, also pretty negative as well. We had weaker than expected China PMIs coming through this morning. So that's posing a bit of a downside risk to some of these China-exposed indices. The Nifty also, you can see trading in negative territory. And this after the trade deal with India was agreed, but with a higher baseline tariff of 25%, so higher than what South Korea or other countries in the region got there. So 25% for India. And then the Nikkei up 0.8%. The main news overnight there was the Bank of Japan. It held its benchmark interest rate steady at 0.5%. But then interestingly, also raised the inflation outlook more than expected. So with that, let's get out to our reporter, Peter Jackson, who's in Tokyo, I believe. Paul Jackson, apologies. Let's just talk about what we got out of the Bank of Japan and the fact that they raised their core CPI estimate for this year. So not really committing to anything, but at the same time, revising upward the inflation outlook.
Yeah, I think that's a fairly strong hint that we've got a rate hike coming in the months ahead. They did three things. They raised their forecast for inflation for this year up to 2.7%. That's quite a bit higher than had been expected by economists. They said the risks were not so much on the downside, they were more balanced for prices. So that also suggests there's a stronger inflation trend continuing. They also said the way they described uncertainty, and remember we've got Donald Trump's tariffs, his trade policies wreaking havoc across the world in the global trade. We've got a lot of those deals in the bag now, including Japan. So in terms of the uncertainties that were there at the last meeting, well, we've got more clarity there, right? So that kind of paves the way for a rate hike to come. So we've got three meetings left the rest of this year. We've got September, October, December. September still looks a little bit early because you've got to see how these tariffs impact the economy. You also want to see if businesses are still feeling upbeat, confident about investing. There is a Tankan survey from the BOJ at the beginning of October. So probably they want to wait until they've seen that, maybe go in October. You could argue they want to wait for more time and go in December. But based on what we've seen today, I would say October's now looking like a stronger possibility.
Yeah, if it indeed does happen. How does the political backdrop weigh on the situation? About a week ago, we were talking about the defeat of the LDP in those upper house elections. Now, the Prime Minister, Shiba's fate is even in question. How's that likely to influence the course of action from here?
Well, it does complicate the political situation, doesn't it? If we don't know who the Prime Minister is going to be in the coming months. Ishiba's lost now 3 elections in a row, if you include the Tokyo Metropolitan election. So he's showing he's a vote loser. They've lost the majority in both houses of Parliament. So the LDP is really needing a change. But at the same time, they've got a pretty good trade deal. Polls show that voters are really against the LDP rather than Ishiba. And also, he's pretty good at talking with the opposition, so maybe that's what you need if you've got a minority in all the houses. So he could soldier on. That's what he says he wants to do. If it becomes a new leader, and if that happened, I would imagine that would take place in late August or September. Out of the 2 main candidates touted in polls, we've got Sanae Takaichi, who's like a Abenomics Mark II. So she might want to slow the rate hikes, whereas if it's Shinjiro Koizumi, probably it will be no change to the current pace.
Interesting. Okay, thank you for giving us the possible contenders if Ishiba does indeed step down. Bloomberg's Paul Jackson. Joining us now is Trinh Nguyen, Senior Economist for Emerging Asia at Natixis Corporate Investment Banking. Trinh, I'm sure you've been really busy the last few months with everything that's going on in tariffs and trade deals. Let's just start with Bank of Japan. You heard our colleague there talking about perhaps setting the stage for an October hike. Is that your baseline scenario as well with the Bank of Japan?
Well, very similar to President Trump, I think JPY is very exasperated with the fact that the dollar is not moving and the Fed is not moving, because it's very clear that the BOJ is not in a hurry to hike. It knows that the weak yen is a problem. It's a political problem that lost the election, and it's something that has to be arrested. But raising rates right now is not on the cards. So therefore, the dollar is in the driver's seat because the BOJ is probably going to have to wait for the Fed to move first, as it's not in the mood. Even if wage growth is there, the uncertainty isn't really about the rate that Japan has, which is we know they has a relief from the 15% auto, plus a weak JPY is very positive for Japanese autos. But it's really the 15% reciprocal and also uncertainty on what that means for the U.S. consumer. Will that impact the volume purchases? And I think we're going to start to see weakening of U.S. data, which means that while we get the rate cut for the U.S., we'll get probably very weak external demand. So the BOJ is going to hold tight. The market understands that, and that's why JPY is also exasperated and waiting for the dollar to react.
Interesting. I'll pick you up on the U.S. data in a moment, but I want to ask you about all these trade deals that are being inked with various Asian economies. It seems as though 15% is almost the new zero here. That's the new baseline rate. But of course, it's not zero. There are going to be economic consequences from having a reciprocal tariff rate of 15%. How are you adjusting your growth outlook for the various Asian economies that have come to these trade deals with the United States, even though there is a trade deal? Again, the tariff rate is higher.
Absolutely. And I think the key here is that, A, the U.S. is a big consumer market that everyone is coming through, accepting that the 15% is the new zero. Some accepting in the 20s, 25, which means costs are higher for the U.S. Some are actually absorbing the costs, which means profit margins are being eroded. We see that in China, the PMIs was very weak. And so we're probably going to see weakness in exports ahead. There have been some front loading, so the data is a bit lagged. So we're probably still going to see pretty decent summer data. But significant weakness is coming up, and that's why central banks across the region are being very cautious, right? We got the MAS being cautious, we have the BOJ being cautious, and so we're going to have to wait and see what happens next to the largest importing market, because that has an impact on the exporters of the region. And remember that we're still facing only 10% reciprocal tariffs. So while the 50% is better than what was threatened, it is a higher rate. While 20% is better for Vietnam than 46%, it is still a higher rate. And there's a lot of uncertainty around a lot of the special mentions of transshipment. So in other words, I think there's a lot of weakness coming ahead, and the weakness in the U.S. filters through the rest of Asia because we're huge traders. So we're going to be very cautious in the coming months. And I think this is exactly why central banks are leaving policy window to react. And meanwhile, I think fiscal policy is coming through to provide that net buffer.
Let me ask you about the India trade deal as well. They seem to have got the short end of the stick, 25%. What do you make of the fact that India have got a much higher tariff rate than other countries in the region, including South Korea, Philippines, Japan? And do you think that that is a rate that's going to stick?
Well, I think there's room for India to go potentially to 19%, maybe 20%. But what would India would have to give to get that, right? The 50%, as you mentioned, is the new zero. That is something allies get, like the EU, Japan, South Korea. And in exchange for that, not only do they have a much open market from auto to others, but also they have investment pledges and purchase pledge. While India is liberalizing, but the pace in which it's doing that is going to be very much slower. The UK-India trade deal shows that it's opening up the auto sector, but in a very gradual manner over a decade, and only in this luxury segment where it doesn't compete. What that means is that India is going to consider this and say, well, wait a minute, we may at best get 19%. And therefore, it's going to be very cautious. And that's why the deal with India is a difficult one to achieve, because what Trump wants is to be able to access that really big, large market, which right now is very protected.
Yeah. Trinh, thank you so much. A pleasure to have you come on our show today. Trinh Nguyen, Senior Economist for Emerging Asia and Natixis Corporate and Investment Banking. And coming up, a Qatari telecoms company, Ooredoo's first half profit rises 4% year-on-year. We speak to the group's CEO about the numbers and strategy for growth and investment next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Persechi in Dubai. Bain is winding down its consulting operations in South Africa, drawing a line under a reputational crisis that's dragged on for years. Our Chief Africa correspondent Jennifer Zabazaja joins us now from Johannesburg. Interesting decision out of Bain, Jen. What triggered the decision to shut down its South African consulting operations?
Right, Jumana, for many people, it's just another indication of reputational damage for some of these consulting firms and another casualty, really, of the state capture era here that really dragged down the economy. So, Bain had been operating in South Africa since 1997, but had been at odds with South Africa's national treasury, which for quite some time had been accusing Bain of what they say and engaging in corrupt and fraudulent practices. Now, a lot of this does date back to the time of former President Jacob Zuma, and the contract that Bain had actually been contracted for here in South Africa was meant to help support the country's tax agency, but after a number of reports and investigations, was actually found that Bain actually contributed to unwinding some of the tax agency, and we've heard from President Ramaphosa, who has said that during that time about $28 billion was stolen from state coffers. And so although we have heard from Bain, they had tried to at least mend relationships with the government. They had been banned from operating here since 2022 because of legal disputes. But it seems like a lot of their efforts to at least mend some of the relationships did not go very far. And they say that this is the end of their time, at least operating here on a consultancy basis. But yes, it seems like just another casualty, despite Bain saying that they did make some mistakes during that time. They say that they were not willingly engaging in what some of these allegations that they've been accused of. So yes, an end of an era, I guess, for this consultancy firm.
Yeah, what does it mean for future engagement, business operations in the country? Is Bain completely out of the country now? Does it create a space for others to step in?
Well, it's interesting because if you talk to President Ramaphosa, he still seems to have a bit of concern about any sort of operations from Bain and other consultancy firms here in the country. Right now, the real question that we're trying to figure out is what does this mean for the upcoming G20? We had heard that Bain and also another consultancy firm, McKinsey, had reportedly been working with the business organization, the B20, that happens just before the G20. President Ramaphosa had expressed his concern about this. So we're wondering, what does Bain now shutting down their operations mean for their involvement with that upcoming summit in November? But we did hear from Bain. They said that they're going to retain most of their staff here in South Africa. They're not saying exactly how many are going to be here and or why exactly this decision was taken at this point in time, especially because this legal dispute has been going on for a few years. We don't yet know what the outcome of their disputes with the governments are right now, but they are saying they are winding down at least their consultancy operations. And we should note they have paid back all of the fees that they had been accused of being engaged in during the state capture time period. But we're really going to pay attention really closely to what does this mean for some of the employees that are still in the country, and what does this mean for consultancies moving forward who have also suffered reputational damage, not just Bain, but also McKinsey and a number of others that have been implicated for some of their accused ill practices during the time of former President Jacob Zuma.
Jen, thank you so much. Jennifer Zabazaja, our Chief Africa correspondent in Johannesburg. Now for a look at some of the other stories we're following today. Ghana's central bank has lowered its key interest rate by the most on record. The Monetary Policy Committee voted by majority decision to cut rates to 25% from 28%. This comes after the pace of inflation significantly slowed in the West African nation, and policymakers signaled they would continue to ease rates if the disinflation trend continues. Nigeria offered its smallest bond issuance in nearly 5 years, selling the securities at yields last seen in November 2023. The Abuja-based Debt Management Office offered 80 billion naira of 4-year and 7-year bonds at 15.69 and 15.9% respectively. The offer size was the smallest since December 2020, according to data on the debt agency's website. And coming up, we hear more from our interview with Masai Ujiri, the NBA champion coach and co-founder of Giants of Africa, on investing in Africa. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. The U.S. Treasury Department has imposed its most sweeping Iran-related sanctions in 7 years, targeting an international shipping network controlled by a prominent oil trader. Hussein Shamkhani was sanctioned along with dozens of individuals, companies, and vessels in his business empire. His father is a senior advisor to the supreme leader, Ayatollah Ali Khamenei. The designations mark the biggest escalation in sanctions targeting Tehran since President Trump returned to office. HSBC's Swiss private bank, is the focus of an investigation into suspected money laundering connected to the alleged embezzlement of hundreds of millions of dollars by the former head of Lebanon's central bank. Swiss prosecutors have been investigating the case surrounding Riyad Salameh, and Lebanese prosecutors charged him last year with embezzling public funds, forgery, illicit enrichment, and money laundering. Masai Ujiri, NBA champion coach and co-founder of Giants of Africa, officially unveiled the flagship Zaria Court as a $26 million mixed-use development in Kigali, Rwanda. Ujiri, in an interview with Jen Savazaja, said he believes the opening provides a blueprint for a new era of sports-anchored real estate investments in Africa.
In terms of market, it's limitless. Yeah, it's unlimited because we can go to anywhere on this continent and you feel, as in Addis Ababa, it's so vibrant, you know, like you go to Dar es Salaam, it's incredible. Accra, what they are doing with, you know, Nigeria with 30 December, you know, there's so many things that Kenya, look how vibrant the youth in Kenya are, you know, like look at what Rwanda is doing. I say again, you know, like, and sports puts us in a position. Music puts us in a position, food puts us in a position, culture puts us in a position, I think, you know, like to bring all of us together. And that's what we talk about in the festival, is a borderless Africa, to bring all of us together and exhibit this and show this and give our youth a chance to really create jobs, to have careers for them, and for them to express themselves, you know. And I think sometimes in Africa we really underrate what we have. And it's time we look at ourselves, you know, like I want to do more on this continent.
Is there enough support from the countries to get you there, Masai? Policies, frameworks across the board?
It varies from, it's a very, very good question, Jennifer. It varies from country to country. You know, rules, regulations is the borders we're trying to bring down. But countries have their rules, they have their regulations, they have their policies, and honestly, you work with them, you know, like we're going to force their hand, you know, like I'm really going to say that. We're going to force their hand to work with us, yes, because we need it, and it's time they pay sports attention on this continent. You know, I think we have to be aggressive. I think we have to be the ones that educate them. We have to be the ones that give them all the information that's needed, yeah, so they know, because sometimes they don't know and sometimes they don't understand.
That was Jennifer Zabazaja, our chief Africa correspondent, speaking with Masai Ujiri, former Toronto Raptors coach and co-founder of Giants of Africa. Okay, we are getting so many earnings this hour. We got Standard Chartered, SocGen beating estimates and announcing buybacks. Also just getting results coming through now from BBVA. So let me just bring you some of the headlines there. Here is what we have. The CET1 ratio fully loaded, 13.3% versus 13.2%. Second quarter net interest income slightly more relevant for investors, coming in at 6.21 billion versus estimates of 6.22 billion. So basically in line on net interest income. As for the second quarter net income, that has come in at 2.75 billion versus estimates of 2.35 billion. So we've got a beat on net income, net interest income coming in line. Looking for commentary surrounding Sabadell, nothing yet. But what we are getting is more and more commentary around the numbers And basically what we're getting is numbers that are slightly above or in line with the estimates. The second quarter net income, though, it beats. As for Société Générale, just a recap there, they have announced that they will start a €1 billion share buyback as of August the 4th. Authorizations from the ECB have been obtained. They see return on tangible equity for the year of 9%, so that's an upgrade from the 8% that they had before. Net income also a 31% year-on-year increase, a beat versus the estimates, so $1.45 billion. And then Standard Chartered, we also got an announcement of a buyback, $1.3 billion share buyback announced today, and also a big beat as well, with pre-tax profit of $2.4 billion coming in above the $1.9 billion estimate. So a couple of beats coming through. And don't forget that our colleague Lizzie Burden will be speaking to the CEO, Bill Winters, on the next show at Daybreak Europe in about half an hour's time. So stay tuned for that. This, as the market digests all of the news coming through from the tech space. Take a look at NASDAQ up 1.4%. Meta and Microsoft really driving gains there as we continue along with earnings season. Lots to come out of Europe this morning. But that's it for Horizons Middle East and Africa. I'm Joanna Bersecci in Dubai.